For me, Bitcoin is just an energy-linked neutral reserve asset for the people. The energy link is that proof of work algorithm that is usually spun as wasting energy, wasting electricity, bad for the environment. At the end of the day, you can't have Bitcoin without a significant expenditure of energy. And so what I want to own are assets that, as it gets easier to produce currency, which it's going to have to in order to sustain that government debt level, negative real rates, I want to own assets that are basically energy linked, that will preserve my purchasing power and energy. And that's what Bitcoin does. I look at it as just a neutral reserve asset for the people, energy linked.
Welcome to the On the Tape podcast. I am Dan Nathan, joined by Danny Moses. Danny, how are you?
I'm just enjoying this bull market, Dan.
Well, it is a raging bull market. We're going to get to all that. Guy Adami is not going to be with us today. He is emceeing the FDNY annual gala, which is pretty cool for him to be doing that. Danny, you're a big supporter of the FDNY.
I am a huge supporter of the FDNY.
All right, so here's the deal. If you guys miss Guy in this segment, Guy and Danny had a great conversation, which is going to be the B block of this fine podcast, with Luke Gromen. Luke is a return guest to the On the Tape podcast. He is the founder of macro strategy firm, The Forest for the Trees. Danny, what were some of the things that you guys hit in that conversation?
We hit the fact that when he was last on in February that he went bullish on the equity market, which was the right move. So I did the famous James Earl Jones voice. Instead of saying, Luke, you've gone to the dark side, I said, Luke, you are my daddy, because I tried to convince him not to do it. We talked about his love of gold and Bitcoin, which has been correct. He talked about the deficit. We talked about the oil-gold relationship. A lot of stuff, really interesting. You're smarter if you listen to it, for sure. So.
All right, fair enough. I look forward to listening to that. I'm sure as our listeners and viewers are. All right, so you mentioned the bull market, Danny. It's all in one right here. The S&P 500 breaking out to a new all-time high. The NASDAQ lagging a little bit. The equal weight S&P, we highlighted this a couple occasions over the last couple of weeks, the outperformance there, which spoke to a broadening out. The equal weight, the RSP, made a new all-time high last week. So in advance of this, Danny, it's interesting that today on that gap, okay, so the Fed chair, Powell, cut interest rates 50 basis points on Wednesday. We closed at the low on Wednesday. We gap up here today. The S&P is only up 2% relative to the NASDAQ, up 3%. Talk to me a little bit about that, like what you think is going on here, beta chase, and the like here. But again, this is a relationship where the NASDAQ had been underperforming the S&P over the last couple of months.
There is a lot of overlap, though, and the top performers in the S&P are tech companies, right? For the most part. So there is some obvious correlation there. Listen, we're at the time of year now where hedge funds cannot afford to underperform by a massive amount, and their hand gets forced on a move like this. I think people are a little bit confused on what is the catalyst that happened from 2 p.m. to 4 p.m. yesterday, or 2:30 to 3:30 or 4 yesterday, the close, and waking up to a big rally in futures this morning. And I think it's just feeding on itself, Dan. And again, it's not a huge difference in the S&P when you're already talking about extended valuations of being 21 times, moving to 22 times in the sense, you're effectively moving up just over 4% on that. So I think that's all we're seeing here is a recalibration. I want to stress, though, that, Powell obviously gave, in the Fed with their dot plot, which comes out quarterly, gave the soft landing to no landing scenario. And so in their minds, they've achieved what they wanted to. For them to think, though, that unemployment will peak at 4.4% in this environment, to me was my one takeaway. I just don't think is realistic. That's saying we're not going to have any type of cycle at all. And I guess that's what the market is really pricing in here is we're not going into any type of recession. There's nothing on the horizon. Rates can afford to come down a little bit without stoking inflation. But again, I think the proof is back on the bears again. And when I say that, I mean, prove to me that earnings are going to slow down in 2025. I know Butters at FactSet has done a pretty good job of forecasting what that looks like. And as we roll into 2025, I think 24 is now going to be, behind the scenes as far as even yes, we're going to get Q3 reporting, which I know is going to be important. But people are now going to start to focus on 25. So that's where I think we're headed here. Dan.
Yeah, no doubt. I mean, listen, all year long, there was a lot of folks, a lot of strategists really skeptical of that year-over-year S&P earnings estimate of up 11%. And it feels like it's going to possibly hit that level. Even if it's a little lighter, that's fine. I guess that 14% year-over-year number, which is the estimate per FactSet in 2025, that's the one, to your point, everyone's going to be really focused on. So a month from now, we're going to start getting Q3 earnings and Q4 guidance. But, a lot of these inputs, if you think about crude, which is a bit lower, I know it's had a big rally over the last week and a half or so. It got to the mid 60s. Now it's the low 70s, but it was, $80 a few months ago. Yields have obviously come down here. The dollar weakness could be really interesting for U.S. multinationals as they think about that with Q4 earnings or start to look out to 2025. So there's a lot of moving parts. From those macro standpoint, we're not even talking about the potential for geopolitical, obviously our election here. The one thing I took away, Danny, and I don't think this is a huge surprise. I mean, Fed Chair Powell said they've reached some sort of balance between their dual mandate, which is full employment and stable prices. So again, that speaks to a sort of soft landing, giving them the ability to start lowering interest rates. But the one takeaway, and I think he got a couple questions about this, was housing inflation. And he highlighted the fact that this is one of the stickier spots, right? So talk to that a little bit, because if you do see housing and rent starts to come down a bit, then you really pretty quickly get to that 2% inflation target that the Fed spoke about. And then you have the ability, or they have the ability, to lower rates even further.
Yeah, it's certainly been an important component in all the inflation metrics have been housing, obviously. And if that were to your point, come down, and maybe that's what they think is already going to happen, but you can tell by what their what the prediction is for inflation, for GDP growth, which I think is going to sit at 2% inflation, which is going to continue to come down. So again, they painted a scenario that is very Goldilocks oriented and very soft landing. I want to take a step back to your macro call and the effect on the dollar and the currency. So we had Bank of England this morning. I only highlight it because they did not cut rates. They're continuing with the QT. And when you see the sterling start to move back to where was it? March 2022, 1.33. There's not a coincidence that was the time the Fed started raising rates, right? Started raising rates for the first time. And so you got to start to think about, again, not today, not for this trade in the market, whatever's going to happen. To your point, though, which is a good one, you have other things that are going to be occurring that are major inputs, Dan, into companies, into multinationals and the dollar and the impact. We have the Bank of Japan tomorrow. As people listen to this, it would have happened. I expect them to be somewhat dovish. I can't imagine that the Fed went 50 basis points without coordinating at least something with the Bank of Japan. So I guess, Dan, all this stuff is happening, and we got to go back to, what happened in early August and early September. Maybe there's some macro event that catches people off guard. And I like to use these opportunities in a run like this, Dan, and you're looking at stocks across the board, to curate your portfolio a little bit the same way you should be doing it when the market sells off in early August and early September to take advantage of a drop in prices to buy. Just be honest with yourself in the portfolio and say to yourself, did what the Fed did yesterday, does it impact my company fundamentally? And the next question, Dan, of that is, if my company that I'm invested in is impacted by currency fluctuations in general, rates in general, then it's an input. So long-winded answer to say, yes, housing is a major component, to your point, of the inflationary picture. But beyond that, just taking a step back into the macro, there's still a lot of things that people need to pay attention to. And I agree with you. The geopolitical stuff, I don't know where to begin to start to price that stuff in. It's found its way, I think, into various asset classes, maybe gold, Bitcoin, maybe a little bit of oil here. So we'll see how that pans out.
Yeah, the geopolitics stuff is really about the same things that we've been talking about for 3 years now. It's supply chains. It's, national security issues as it relates to technology. It's, the flow of crude oil and the like. So again, there's not much pricing in for that in the broad stock market right now. But I think in each one of those embedded risk assets, there probably is a little bit of a focus. But going back to your comment about, looking at your portfolio, individual names, how do rate cuts affect that? And it's really, I'm hard pressed to look around on my main FactSet screen that has, hundreds and hundreds of stocks on it and not find, some that are just not affected. You know what I mean? Was that a double negative there? Like one in particular, look at Tesla. So it gapped up a few percent today. That was the low tick of the day. It seems to go, higher as long as the market is open. It's up 7.25% right now. And you think about Elon Musk, the CEO of that company, he's been talking about how higher interest rates for 2 years, have impacted their ability to kind of sell cars and the like here. And they've been buying down rates, which has hurt margins and the like here. So again, folks are piling into this, because they think that there's going to be a rate cutting cycle, which should help the demand for cars like this. Does that make some sense? I mean, obviously it makes sense, but you're you being able to see that it going much further from here, I get it. You know what I mean? So talk to me a
Yeah,
little
you
bit
want me to
about that.
come up with reasons that, obviously it's moving higher. Again, I don't think the rates have an impact, or at least 50 basis points won't, on people's ability to buy the car. To your point, they've been providing low cost financing anyway to get people in the car. If you think that it's going to just help the consumer in general, then it helps all auto companies. It helps everybody, obviously, in general. And I just think you have a weird time of the year here. You have a huge option expiry tomorrow. You have a lot of these zero DTEs being bought in the marketplace right now. Tesla's been one of the number one, obviously, option activity companies that we've seen in a while. So I'll just throw it into momentum. And again, the shorts just covering now. I think that's been obviously a painful trade here. And all the while, Dan, fundamentals not getting any better, but the stock has not traded on fundamentals in a while, and that always makes it a dangerous short. So.
Well, I'll just say this. You're going to see analysts just saying that, the buying down of rates is probably something, obviously, that's been hurting margins. And maybe if you release that in a rate cutting cycle, that's probably reason to get bullish because, at some point, the margins are going to bottom and the story is going to be like, okay, how do they get back above 20%? There were 25% gross margins 2 years ago, right? Before all this stuff. So again, it just makes sense to keep an eye on those. And your point about the other auto companies, GM is up less than 1% right now with an S&P that's up 2% and a NASDAQ that's up 3%, and Ford's basically unchanged on the day. I want to shift gears to some other names in the Mag 7. So on a day like today, we're seeing Microsoft, Google, and Amazon. So all of these hyperscalers meant to be the big beneficiaries of Gen AI, not just the models that they have and they're using across their different suites of products and the like, but also the benefit from the cloud services where a lot of other companies are renting their compute and the like. And we know that they've been building up this capacity for about a year and a half or so. All those stocks, I mean, interestingly enough, you're seeing money flow out of those and going into some laggards, and I could give, no shortage of examples in, enterprise software, which has really lagged some of these SaaS names and the like. We have Salesforce, which was up close to 7% earlier. It's up 5.25%. This is a stock coming into today that was down on the year. So again, interesting that there's this kind of laggard sort of beta trade going on. Danny, how long do you think that can last, especially as we have the NASDAQ, like we said before, underperforming the S&P 500, the S&P 500 trying to hold on to these new all-time highs, which, if you're a bull, you would like to see a breakout and then maybe, establishing a new range above, this consolidation that's gone on the higher end for the last few months.
I think the point you brought up at the beginning about spreading it to the equal weight kind of stocks in general, I think that those three names you mentioned, obviously they're all great companies, pretty well established. It's hard to dream the dream that that 50 bips does anything for them, necessarily moves the needle that much at all. So I just think, to your point, people looking for a little bit more beta, a little bit more action with their money. And those have been crowded, they trade like consumer staples of tech. So when risk comes on, they're going to underperform a little bit on a risk on trade. So I just think you're just seeing a shift, to your point, in some of the names that maybe have lagged within the market, and they're just using that as a source of funds. But correct me if I'm wrong, they're still up on the day. Microsoft's had a nice bounce off of the recent lows, obviously, and that's a lot of market cap. You think about those three companies, to your point, you just spread out those market caps among names that are below the top 20, and you're going to have significant moves in those. So I just think it's a reallocation.
Hey, by the way, I saw what you did there. Dream the dream of other men. You'll be no one's rival. So that's a little unthought known, Danny, from Pearl Jam.
There you go. That's right. Tried.
I know you were at that SEP 3 at MSG, that show a few weeks ago. And, Eddie talked a little bit about, before they played Unthought Known, how I think he said like 20 years ago, he was staying at the same hotel when they were here for shows at MSG that he was staying that week. Okay. And he told the story how he was out late one night when they had the night off, probably in between shows. He said he got a little bit roughed up. He had a little bit of weed and the like here. And he scribbled down some lyrics, and then he had this tape recorder or something like that. And he sang a little bit of the song because he wrote down the lyrics. The next day when he woke up in a haze, it was Unthought Known, which is kind of cool. I literally just heard that this morning. Your dream the dream of other men. I see what you're doing there. Danny,
let me tell you something, Dan. Last night when futures were ripping, I was also up scribbling stuff down questioning my existence at the same time. So I may have a new song after that from a while. So
Yeah.
that's a really good comparison.
All right, let's
Very
talk a
good.
little bit about banks for a second here, because again, we've talked about this a lot over the last few years. We know what got some of these regional banks in trouble. We know what was holding back Bank of America, right? Like some of the stuff on their portfolio, these mark-to-market situations there with these low yielding treasuries that they loaded up on, right? I guess in 2020 and early 21 and the like here. What do you think? I mean, you've traded banks through lots of different cycles here. Some of the money centers I'm looking, Citigroup is up nearly 5%. Wells Fargo is up 3%. Bank of America is up 3%. JP Morgan, which obviously, has been an outperformer leading up to about a month ago, is up a little less than 2% or so. How do you think about these banks? Because again, they did well when rates were going lower. They did well when rates were going higher. They're doing well on a day like today, where they clearly signaled that we're in at least, a rate cutting cycle for the next few sessions. The Fed did say they're going to be very data dependent. We've heard them say that again and again. How do you position yourselves? The BKX is about to break out above the levels where it broke down from, I think, in February, March of 2023, when we started having the regional banking crisis.
So we now are steepening, right? So banks traditionally, 210 is now, lo and behold, double digits, I think, as we sit here today, Dan. I think it's 10 or 11 basis points. So that's a positive, quote, thing for the banks, obviously. From a credit conditions perspective, all the Fed did yesterday was ease even more conditions. We'll probably spur on more deals in the securitization market. We'll probably add a little juice to that. So there are impacts of what the Fed actually does that are positive. But I think more important than that, Dan, I think the signal from Powell, I think someone said it, I heard them say he wasn't dovish, he wasn't hawkish, he was bullish, in the sense of he's got your back.
Yeah.
So for him to cut 50 basis points in the midst of all these other activity that we've seen with still a strong employment, all that stuff, I just think you got to say to yourself, imagine if we actually have an uptick in unemployment back to 4.3 again, or even to their ridiculous target of 4.4. What are they going to do? They're going to bring the cannons in. And I think that's really what it is, because Dan, we talked about a month ago when the banks started to kind of pull in a little bit when the markets were selling off. I think it's the wealth effect that you close M&A, you close IPO. So I just think it's kind of people get going in and being a little bit more comfortable. There's also talk again, Dan, on a regulatory front of obviously Basel III being relaxed. And one other thing came up again was the SLR, which is the ratios used on the banks that hold treasuries. And so as we see yields move higher here on the long end, which is dangerous, it's not dangerous yet, but it gets to a point where it'll be meaningful. Will the banks get regulatory relief to hold more of that? So I just think, and Dan, who's the first sector that reports earnings? We know it's obviously all the banks, and they're not going to blow up. So I just think it's just an excuse to move money around and move back in. They had sold off, I think, Dan, they're probably just back to where they were kind of a couple of weeks ago, I'm guessing, in general. And I think that's all that is.
Interestingly, Danny, like a week or two ago, a lot of these banks, I think it was the Barclays, financial services, conference, a bunch of CEOs and these firms, they de-risked a little bit, talking about trading revenues, how they were going to be lighter than expected. And then you just mentioned, the reopening of capital markets. The IPO market has been, dead. The M&A market has been really difficult because of regulatory concerns, right? So folks have been holding off to see what a new administration might hold. Goldman Sachs is up 33% of the year. It's up 4% today. It's very near those prior all-time highs made about a month ago. But it's interesting. Morgan Stanley up less than 2% today. And this one is only up about 12, 13% in the year. So massively underperforming Goldman Sachs. So are you more bullish, if you had to be, on the money centers or some of these more traditional investment banks, assuming soft landing, assuming that the consumer hangs in there, assuming the stock market hangs in there? Because let's assume that there's a huge backlog for IPOs that could get unlocked in 2025, right? If you're seeing what's going on here, if you're the CEO of a private company, you're dusting off that S1 that you were getting ready as you were heading into 2022.
I agree with that. I guess I get torn between where these stocks trade historically on book value and where they trade now. So the point you make is they better have a pretty good ROE, a return on equity, going forward in 2025 to justify where they're trading. I think the safety would be in the JP Morgans of the world, which is really a combination of a money center / investment bank. It's not as pure as Goldman Sachs or Morgan Stanley as an investment bank. It's much more diversified. And to your point, Jamie Dimon's been conservative, obviously, on his outlook. He's basically already warned the street. So from a credibility perspective, If they were to miss or even guide a little bit lower, that's already built into that name. So if you push me into one right now, I still would be holding JP Morgan. Goldman Sachs, obviously, when you see a move like this on Wall Street and the leverage potentially goes back up in the system on rates coming down a little bit, Goldman and Morgan will benefit on that more, in my opinion, from trading activity of funds. So we'll see. But volatility in general is good for the trading investment banks, the Morgan Stanleys and Goldman, and not great as much for the money centers. But I think with JP Morgan, you get a little piece of everything. And to add to your point about this conference a few weeks ago, let's not forget the auto credit card delinquencies, those things, which are much bigger on some of the regional banks, a much bigger issue. That stuff's not going to stop trending that way just because the Fed cut 50 basis points, Dan. And so I think that we get into earnings season, we'll look to and delineate, I think, some of the regionals and the big money centers in general and the investment banks. And I think we'll just have to see what they say.
Yeah, I mean, the one thing I'll just say, again, going back to the banks, because, they're the lifeblood of the economy, as folks like to say. I mean, let's just say Fed Chair Powell, he indicated 4.4% by the end of the year unemployment. You know what I mean? He didn't kind of speak too far ahead of that. He talked about, GDP hanging in there, at pre-pandemic levels and the like. If, that's the case as we get to the November meeting, right? And then there's a December meeting, you could see them if inflationary readings, and we're going to have, 2 jobs report, 1 CPI, 1 PPI, we're going to have a bunch of data. You could see them, easily going another 50, I think, front end loading this, because again, what do they want to do? They want to support unemployment now that they feel like inflation's come down a little bit. But Danny, I want to take it right before we get to the Luke conversation. Carter was calling, the plowing into utilities and staples, the face of fear trade, right? And so they were working. We're going to get to gold in a second, but the fact that they're down less than 1% today, as the NASDAQ is raging and so much money has kind of been put back into these names that were powering a lot of the gains, right before the summer or so. What do you think about some of those names? Do you just kind of let them go, or if you think that the market is not going to be able to sustain this kind of enthusiasm, do you get back into some of those trades?
I think there's new money coming into the market as much as there is a reallocation that we talked about. So that's probably, I don't think money's leaving those names per se. Those are still safety trades. I think people that own those names for safety, there's enough reason to still be fearful going forward that you would still own them. You're going to have decent earnings growth. I think there'll be a point, Dan, if the 10-year yield starts to get through 5%, where some of these dividend yielding companies, right, do look a little bit less attractive, and the fear of a slowdown, again, I think would move people a little bit into cash. But again, with short-term rates coming down, Dan, in general, you're seeing money come out of the short end, I think, of the bond market, so to speak, in terms of duration, and coming into the stock market. But again, I think a lot of this, Dan, is predicated on this. We're kind of stuck in this good zone of, all right, 10-year yields are up, but not too much. Get me to 5% on the 10-year, I think we're going to be having a different conversation. But I still think the one takeaway, obviously, from Powell cutting 50 basis points, we know what's happened in history when you cut 50 basis points. Again, I think that this cycle is unlike anything we've ever seen, so I'm not going to try to compare it. But I do think that people are a little bit nervous. And Dan, the point you just made about the unemployment rate, again, I find it a little scary that the Fed has us going to unemployment of 4.4% here very soon, and then peaking there. So to your point, if we get 4.5 or 4.6 somehow, they're going 50 basis points because they waited too long when inflation, they thought it was transitory 3 years ago. And to your point, now they're going to do the opposite, and they're going to front run all this. The danger is not now. The danger is probably not even first quarter next year. The danger is if they front run it too much and they want to ignore inflation, which is still not down at 2%, and it doesn't start to go down, have you restoked inflation? That's not a conversation for today. But again, that's what I think people will start to think about, Dan. So if you have job losses mounting, but inflation that is maybe even stabilizing or starts to move higher because they're injecting so much capital or credit conditions ease so much, that's the danger zone to me.
Yeah,
Dan.
but unless we go into recession, the unemployment rate's not going to go that much higher. And historically, and Fed Chair Powell said this, we're still at very low levels. And you got to remember, what did the Fed try to do? They tried to ease, the kind of strength of the economy and the pace of hiring, right? And so, we've seen wages kind of settle a little bit. We've seen the unemployment rate go from 50-year lows at 3.6%, up to 4.2%. So maybe it doesn't go as high as many people think. If the soft landing was achieved, then the economy can keep humming along at 2.2% or so. It was doing better than that for the first half of the year. So expectations aren't particularly high for the back half. So again, I think there's an easy, safe landing or soft landing case to be made here. And you can go back and say, I mentioned this on Fast Money the other night. We went back and forth in 2021 about the transitory call that the Fed made. But when you think about why we had the inflation that we did, we had a black swan event. We had the breakdown of supply chains, right? We had the hoarding of different things. We had we had capacity issues on all these other things. We had supply chains as a matter of, national security. We had the chip bans. We had so many different things going on. And then we had the uncertainty of when this was going to end, right? And a lot of people, were like, listen, we could have different waves of this. And we had different waves of people getting vaccinated. So for all intents and purposes, and a lot of economies opened up at different levels, the transitory thing, he was probably right about that. And, when you think about, inflation or the CPI in particular going up to 9%, I mean, you think of the monetary that we threw at the monetary policy, going to zero so quickly, and then the fiscal stimulus. I mean, what did they do? They avoided a global depression, right? So if you think about the backside of this is that we had 1.5 years of inflation way above trend, but we had unemployment very near 50-year lows after that quick spike during COVID. I mean, it's going to look like Jay Powell's going to look like a hero. I'm just telling you, if we really get out of this with a soft landing. So I just think there's very little criticism at this moment to have, because a lot of those consumers, right, that are complaining about inflation, and they got reasons to complain about it, it's kind of out of our control in a way. If the Fed started raising rates in like mid 2021, it might have put the economy in a recession, right? I mean, so I'm just saying there's a lot of ways we can look back on this, but I think at the end of the day, if we get out of this without a recession, and I know a lot of people think that's a bad thing to kind of, manufacture, an economy that doesn't, take the business cycles out of it, but it's been a pretty weird few years, Danny.
Well, that's a good preview to the Luke Gromen conversation. He touches on all of this, and he touches on the fact that the fiscal deficit's been running now at 7 to 8%, which is having a direct impact on growth in the economy. And the other thing he talked about is how you define a recession or not. There's two different economies going on at the low end and the high end. And he talks about that as well. So definitely listen. And I think a lot of the issues that happened during COVID on the supply chain, the issues were transitory. But to your point, the fiscal and monetary stimulus that came in, maybe a little uneven in the sense of maybe you didn't need all of it, but we got it. And it is what it is. And we're going to work through it all here, obviously. But let's look at the balance sheet, and we won't go into it on this, but someone is responsible for the money in the system. And it's the U.S. government, and it's sitting on $36 trillion in debt now, Dan. And the fact that we're trying to basically slow down quantitative tightening also at the same time tells you, again, not for today discussion, if rates start to move up again on the 10-year yields, at what level will it start to matter? It's not.
Yeah, so. And I guess the point, and we'll leave it at this before we get to Luke. What would be the conditions right now that would cause the stock market to sell off, that would cause the Fed to kind of pause in their rate cutting? It would be restoking of inflation. But the fact that they went 50 right now, they feel like, again, the dual mandate, is kind of balanced right here. You know what I mean? So I don't know. I mean, I think it's going to be an interesting argument, and no one can ever foresee the reasons why the stock market sells off. But right here, right now, it feels like with the economy going the way it is, that people feel pretty comfortable owning stocks even at these valuations. So the NFL, we're in week 3 right now. You're going to give us 3 picks. Let's hear what they are.
All right. I'm 2-5. Hopefully I win these 3. Starting slow, I'll end hot. All right. Falcons getting 3.5 at home against the Chiefs. Pacheco going down for the Chiefs is not great. I like the Falcons getting 3.5 at home. Like I said, short the Super Bowl champs against the spread for the year. Steelers started out as 2-point underdogs. Are now 1.5-point favorites in their home opener against the Chargers. Herbert may or may not play. I'll take the Steelers either way, -1.5. And then, Dan, there's 2 Monday night games this week. There's actually 4 Mondays this year where there's 2 Monday night games because Disney spent so much money on the NFL rights. They need to justify it. So they're taking on ESPN, which is really nuts. So that gives you an idea of what these media rights will do to our football watching. But Cincinnati at home, given 7.5 against Washington. They're 0-2. They can't be 0-3. They got to come out strong. I think Washington's still a young team. I like Cincinnati -7.5 those are my three picks.
All right, I got a question on one of them, and you and I haven't done this in a couple of years, and you kind of smoked me. No. So Atlanta had that crazy upset last week, right, of the Eagles, or that was on Monday night.
It wasn't that. I mean, it was crazy the way that it panned out. Correct, and I was on the wrong side of that.
Right. So
yes.
you have Atlanta at home hosting the Chiefs, and you want to take the Atlanta with getting 3.5 points. Is that correct?
Correct.
Okay. And so the Chiefs, have they not covered these first 2 weeks?
They covered week 1 against Baltimore
Yeah.
barely, and they did not cover last week against Cincinnati.
All right. I'm going to take the Chiefs minus 3.5
Yes.
on the road versus Atlanta. There you go. This is gonna turn you around, buddy. I hope you win. We're going to do it for a hundy. And
You got
let's
it.
get you
Hundy.
going. Let's get you flat on the year, okay, in week 3.
Yes.
All right, man. That was
Let's go.
fun. We covered a lot of ground here. Crazy day. We're getting towards the close in Thursday afternoon. You better hope they hang on here, because if there's ever a reversal, maybe this is some funky stuff in front of that triple witching that you mentioned before. Who knows? Which could make tomorrow a pretty interesting day. So, Danny, thanks for being here with me. Look forward to the conversation. We'll see you next week.
Welcome back to the On the Tape podcast, the moment you've been waiting for since February 4th, I believe, of this year. Why do I mention that, Danny Moses? Why? Please, Danny, answer that question.
Because we have Luke Gromen back on, who, by the way, went bullish this year. I begged him not to. I even did the James Earl Jones, Darth Vader, Luke, you're my father. I guess he's my daddy at this point, but tribute to James Earl Jones right there. But Luke, welcome back to On the Tape podcast. Great to have you back.
Thanks for having me back on, guys. It's great to be here.
It is a treat for us. Danny and I are total wonks, and I'm not suggesting you are, but you can get in the weeds better than anybody that I've seen or heard or read, but you can do it in a way that makes people understand what you're talking about. And again, kudos to you, because everything you talked about earlier this year has absolutely come to fruition. And as we're sitting here, this is Wednesday, this is Federal Reserve Day. It's about 3 o'clock in the afternoon on the 18th, and we've just learned that the Federal Reserve, probably in a 50-50 vote in terms of what the market was looking for, cut Fed funds by 50 basis points. So let's start there. Obviously, I think you thought this was going to happen.
To be fair, I was kind of indifferent to what they did today. To me, I thought they were going to have to get more aggressive. I didn't have a lot of conviction of what aggressive looked like, and whether that was 25 today or 50 today and more later. But to me, what I've been very focused on has been the way that the rise in interest rates was driving interest expense up for the U.S. government, and was pushing the combination of on-balance sheet interest, which is just the interest on the debt, and then off-balance sheet interest, which is just the entitlements. When you add those two numbers together, those two numbers are getting closer and closer and closer to 100% of receipts, and receipts are interest rate sensitive. So it was very clear, this pincer that the Fed had put themselves in as a result of the mistake they made 2 years ago, which was not letting inflation run high enough for long enough to get debt to GDP down to something more sustainable. So I didn't know when this was going to happen exactly, but to me, it was pretty much fait accompli, and just a matter of managing your chips until they were forced to do this.
All right, let's talk about managing your chips, because I did a little research myself, and the last 2 times I believe the Fed led with a 50 basis point cut was in January of 2001, and the market proceeded to go down about 40% over the next year and a half-ish or so. And then again in September of 2007, where over the course of the year, I think the market went down north of 50%. So if history repeats itself, if history repeats itself, we're going to find out. But this should be the start of something in terms of the market. So you've been bullish of equities. You have been correct. But does today signal sort of a harvesting that crop that you so elegantly planted and fed and watered?
No. And the reason it doesn't is because in 2001, the bubble was in stocks, and in particular, .coms, et cetera. It burst. Ultimately, we kicked that problem upstairs to the banking system by, as Paul Krugman famously recommended, creating a housing bubble to make up for the lost demand from the stock bubble bursting. That takes us to the 2007 or 8 instance that you referenced, where they did the 50 basis point cut off the top. That bubble burst, the housing bubble. They kicked that problem upstairs to the sovereign balance sheet by virtue of backstopping everything and everyone, which is a bit flip, but not that flip. That brings us to today's 50 basis point cut. I agree. I said this to someone earlier this afternoon. Someone said, well, then maybe there's a financial institution, a big financial institution in trouble. I said, absolutely there is. It's the United States Treasury. And ultimately, that's where the bubble is. The bubble's in the Treasury market. The bubble's in Western sovereign debt. And so with that being the case, ultimately, I think the release valve to this cut is going to be the dollar and inflation. And so it brings us to a point of nuance in terms of what stocks do from here. In dollar terms, I think stocks keep going up, particularly industrial stocks, electrical infrastructure, some of the things that will benefit from investment here. In gold terms, I think stocks are going to go down from here. In other words, I think stocks are going to underperform gold. I think they're going to underperform Bitcoin. It's a little bit of the, it's a U.S. with Argentine characteristics dynamic, right? Where if you look in peso terms, peso percentage terms, the Argentine stock market's been a monster for the last 20 years. Doesn't mean things are going great. It just means the currency sucks. And similarly, again, directionally, it's not. It's U.S. with Argentine characteristics. It's not Argentina. I think we're going to see dollar weakness. I think we're going to see stocks go up in dollar terms as the $130 trillion bond market squeezes out of bonds and into, call it 65 trillion of equities, 14 trillion of gold, and a trillion, give or take, of Bitcoin.
Let's come back to gold and Bitcoin in a bit. I want to go to the theme, which is the reason that I believe you went bullish on equities, which was the fiscal deficit was basically going to be supporting global everything. I mean, so when you're running a fiscal deficit of 7 to 8%, my question for you is obviously that's not sustainable over the longer term. But when you look at Medicare, Social Security, defense spending, government spending on things like the IRA, whatever it might be, it's hard to see how that 7 to 8% is making its way, quote, into the system. It's almost like it's just keeping things at bay. So how do you measure from an incremental fiscal deficit basis, how much of that is finding its way kind of to inflating the markets themselves? I'm curious how you do that math.
No, it's a great question. And it's not, there's some ways you can do it from a big picture standpoint, and then it gets sort of trickier, right? So you can say, and we have said, okay, U.S. GDP, the government is, call it 25% of GDP. And if U.S. government spending is growing at 10%, that's 2.5%, 2.5 points of GDP right there nominally. And then you look at 75% of the economy of GDP is private sector and interest rate sensitive. But if the government is growing GDP 2.5% by itself at 25%, then the other 75% needs to fall 3%, right? Give or take, just a little bit more, about 3.5%. Is that right? I think that's right. Let's just say 3% needs to fall 3% to basically get you back to flat on GDP. And that, by way of context, total GDP in the U.S. fell around 3% on a full year basis during the Great Financial Crisis. So basically, you need the U.S. private sector, from a top-down perspective, in breaking this down, you need the private sector to basically have sort of a GFC type decline just to sort of run GDP flat on a full year basis. And I don't think, there's clearly slowing in various pockets. Commercial real estate is under pressure. Housing is slowing. Employment is slowing. But that's sort of point number one to it. And the deficit spend of that factors into that number. In terms of, okay, well, $1 trillion of that spending is interest and it's going into boomers' accounts, and they're not necessarily spending it into the economy. From a granular standpoint, I think your point's well taken, Danny, that it's tough to measure, but that does factor into the second sort of part of why we have been saying and continue to think there isn't going to be a recession. It's basically a mathematical impossibility, which is people 55 years and older in this country have $114 trillion of wealth. They own 70% of the assets. And they are engaged in what we have called the world's biggest YOLO spending binge in history. YOLO, you only live once. So everywhere I go, everything's full. Everything needs reservations, and they're all people 55 years and older. So there's absolutely a bifurcation in the economy. Things are definitely slowing meaningfully at the low end, and they may actually be recessionary at the low end, except in an economy where the 1% are all that matters from a financial standpoint, the top 10%, right? From a financial standpoint, it's harsh, but it means you can't have a headline recession while those people are out spending money like they're going to die in 5 or 10 years, because the reality is demographic, actuarial tables say they are going to die in 5 or 10 or 15 years, and they can't take the 110 trillion with them. And so between this deficit of 8% of GDP, outlays growing at 10%, and then this YOLO spending binge of $110 trillion, that is basically this sort of tidal wave that is papering over a lot of other things in the economy that aren't really going so well, at the low end, in housing, in commercial real estate, et cetera.
You've been correct in calling that there would not be a recession, but you've actually said if there was one, that fiscal deficit would go to 13 or 14%, which would obviously be bad for everything. But you just mentioned that the amount that fiscal is contributing to GDP, if the definition of GDP is 2 consecutive quarters of negative GDP growth, right? Whoever you want to say, whatever it is. So when you say you don't see a recession on the horizon, it may be happening, but it's being masked. Technically the definition of a recession might be happening, but it's being masked. But I want to take it one step further. I'd love you to comment on that. And then your call on bond yields is interesting. And I've joked on this podcast a few times about trading the end of the world. If the term premium, or if 10-year yields start to go higher because of the credit worthiness of the US, I don't know how to even trade that in terms of equity market. So give me your thoughts on that, because I believe that you think that's why 10-year yields may end up moving higher indeed. So if you don't mind rounding that out.
Yeah. So I think on the first point, I think that's right. You get, technically, see, I'd always thought that recession was 2 quarters of negative GDP growth as well. And we got that. Remember, we got that in summer of 2022. And the U.S. fiscal spend was down huge in 2022, in this middle 2 quarters, 2022. But I was told that it's not just 2 quarters of declining growth, but it's also a meaningful rise in unemployment married with that. So I agree with you, Danny, that's 2 quarters of down GDP was always what I was brought up on, but there was this other qualifier of employment. So long-winded way of saying, arguably, we already had the recession in the summer of 2022. In that case, in terms of the decline in GDP, as that then relates back to the fiscal side, if we were to get an honest to goodness recession, with sort of the last 3 recessions we've had in 01, 08, and 20, you had a 600 basis point, 800 basis point, and 1200 basis point increase in the deficit as a percent of GDP. And so let's throw out the 2020 case of 1200 basis point increase in the deficit as a percent of GDP, because it was a pandemic and sort of a special case. So let's just say 600 to 800 basis point increase as a percent of GDP in the deficit in the case of a recession. Let's use 700 basis points on 27 trillion GDP, trillion 4. About $1.9 trillion on top of the incremental deficit within a year or so, on top of the 2.1 we're running now. So you're going to have about a $4 trillion, $4 trillion deficit, which is on a $27 trillion. Yeah, it's 13, 14% deficit. Historically, when you have a twin deficit nation running 13 to 14% of GDP deficits, you don't buy their long-term bonds. You just don't. It's a friggin' disaster. It's like the worst thing you can do. And so where are the bond vigilantes showing up? How does this get expressed? There's a chart I've highlighted a number of times, and all credit for the statement of it goes to Charles Gav on appearance he made on Macro Voices in 2018, where he said, look, I'm watching gold divided by the U.S. long bond. And if gold goes up against the long bond, then inflation's coming back and the dollar's losing and the Americans are losing to China. And if the long bond is beating gold, then the opposite is true. And for a period of time in 2018, that was sort of flat, that ratio of gold over the long bond. Well, now gold over the long bond is like hockey sticking higher in favor of gold. And so ultimately, I think that is the expression of the quote unquote credit worthiness of the United States. Because, of course, the United States can't default. The only way it can default is if they make a political decision to say we're not paying entitlements, we're not paying interest, go pound salt, and that's never going to happen. They can always print the money. Alan Greenspan said as much. We can guarantee payments, and as much as you want, we can't guarantee their purchasing power. He said that to congressional testimony in 2005. And as that purchasing power, then as the creditworthiness of the U.S. gets questioned, it's going to express as gold over TLT, as stocks over TLT. It's going to express as the bond market, and especially the mid to long end of the bond market going, wait a second, I'm the sucker at the card table here. And so of the $130 trillion global bond market, whatever sort of mid to long term, you're going to start to see that shift to the front end. And then you're going to start to also see it shift to anything that better preserves the inflation that comes when you have what really drives the worst inflations in history, which are a twin deficit nation that is no longer able to finance itself in foreign markets at long durations and has to either do it in the bill markets and roll over on a payday loan like basis, like we're doing, or isn't getting financed and has to either rely on banking regulations or QE or the central bank buying it. Those are where the really great inflations come from. That's where we are. And so I think when we talk about how do we trade what is happening, I think the markets have been speaking to us and will continue speaking to us, which is long gold against TLT, long stocks against TLT, especially the industrials against TLT, long Bitcoin, for if you can withstand the vol, so you have to size the position right, it's long Bitcoin over TLT.
This next administration, regardless of who it is inheriting a bit of a shit show, I think. And this is just my opinion in terms of the following. Janet Yellen's she's done a great job in sort of massaging some of these auctions in the short-term paper and stuff. But in your notes, tree rings, the 10 most interesting things we've read recently. Number 3, in the next 3 years, U.S. Treasury has to refinance $15.5 trillion with a T of debt. The weighted average coupon is now 2.3% versus 5.3% for the T-bill yield. So how are they going to pull that one off? Because at a certain point, I think you can only pull so many rabbits out of the hat.
Yeah, all credit for that piece. That was something my friend Larry McDonald posted on X from his Bear Traps report. So I want to make sure to give all credit to him for that. It does frame an issue we've been harping on relentlessly for some time in, I think, a very stark light. And to answer your question, this is ultimately a restructuring type situation at the sovereign level, right? When we go back to the initial point of, hey, 01, the Fed cut rates 50 basis points, we had the dot-com blow up. Well, how did we work that out? Well, sock puppets went bankrupt and the bondholders took over the equity. The equity went to zero and we moved on. We worked things out in the 08 crisis. I don't think it's how we should have. I think we should have zeroed out bank equity and let the bondholders take the company and fire the managements. And some people should have gone to jail, but that's neither here nor there. We dealt with it as how we dealt with it. And so has gotten us to where we are today, which is to say, now we're increasingly having to roll long-term debt at the short end. You can do that for a bit, but as Larry noted, now we've got $15.5 trillion to roll in the next 3 years. And even if the Fed were to slash rates back to zero, if I recall correctly, you're still going to have basically elevated interest expense based on what the Fed's already done. And so you're into a situation where either it's a very binary outcome. Either we're going to sort of experience a new Great Depression, which is to say we need to cut the deficit from 8% to 2%, The problem is that requires, let's say we cut it to 3% for easy math, right? We take 500 basis points of GDP out of the deficit immediately and permanently. The problem is taking 500 basis points of GDP out of the deficit means you got to cut GDP by 5 points. Now you're running a recession. Go back to what we just said about running a recession. You run a recession, the deficit's going to go up 600, 800 basis points. So you will more than offset any cuts because the Fed screwed up this time by not letting inflation run hot enough for long enough to get that to GDP from 120 down to 70. That was their mistake this time. So now we can't cut. We can't cut.
I agree. I'm sorry to interrupt, but I've had now, again, the numbers move each day, but I have debt to GDP approaching either side of 130%. Now, you probably have better numbers than I do, but I only mention 130% because if you go back in history, and history is a long time, no developed economy has ever been able to sort of recover from those types of debt to GDP levels. And, unless, as you've been saying, unless the growth portion, the GDP portion grows, this debt is going to continue to sort of run rampant. So I don't know how you... Again, I mean, you talk about hockey sticks. There's one right there in terms of debt to GDP.
Yeah, ultimately, there's only one way out of this, which is you've got to run very significantly negative real interest rates. In other words, you've got to have the Fed help you keep rates well below the rate of inflation for a sustained period of time and get debt to GDP back down to some much lower level. You're going to be talking about double-digit negative real interest rates for 2 to 3 to 4 years to make that debt load sustainable. And every time they delay doing that, like they did in 2022, the more the negative number will have to grow to get out of this. Ultimately, they can always get out of it. It's always just a question of how high the inflation, how negative the real interest rate, and the political fallout.
So, Luke, of all these things that are moving in real time, currencies, and we're going to talk about the yen in a second, what would make you kind of flip on equities versus staying long gold and Bitcoin, which I promise we're going to get to here? What would make you flip? Because a lot of these things, whether rates move higher, is going to have an impact on equities, right? Faith. And I'll add to that you mentioned before how the top 1% in the US are pretty much controlling spending. Well, I don't think the wealth effect has ever been bigger as far as the stock market and crypto and things that are in there. So throw that all into the mix and let me know, what would it be? What would the signal be to kind of make you go bearish on equities here?
The signal to go bearish, in my opinion, would be a political regime in the United States that basically does what Milei down in Argentina is doing, which is to say, good morning, America. This is President fill in the blank, and we're in trouble. It's time for honest talk. Baby boomers, you're the richest generation in history by far. For boomers, we are cutting entitlements starting in 2025 by 50% permanently. Social Security down by half. Medicare, Medicaid down by half. Maybe the number's 30, 40%. U.S. defense spending. Good day to you all. As effective immediately, we are leaving Ukraine. Zelensky, you're on your own. We're cutting defense spending by 30 to 40%. We are reducing the military footprint by 30 to 40%, bringing our boys and girls home. And we're going to reinvest some of that in education, but mostly we're just going to stop spending so much money. The deficit's now 2%, and we don't care what happens to GDP. We're going to have a down 5 to 10% GDP number, and the Treasury market's going to dysfunction, and repo's going to 8, and we're not going to step in. We're just going to let it go, and if banks blow up, banks are going to blow up, and we're going to fire the management. So we're going to zero out the equity. And if that takes down New York tri-state real estate, residential and commercial, oh, well, you shouldn't have levered up. You should have paid cash for your house. But that's the type of thing that would require. Now, in that case, holy cow, I want to be in short-term bonds. Actually, you probably could buy 30-year paper at that point. You probably could buy 30-year treasury at that point. And you'd want to own the dollar, and you'd want to own some gold. And that's what you need to be bullish on sovereign duration, Western sovereign duration. And I just don't think politically, set aside the economic possibility of what you touched on before, it's impossible given the fact they didn't work down the debt enough to try that without sending the deficit higher. Even if mathematically it could work, which it couldn't politically, I don't think it could work. So that's even something directional in that way, right? Like that's a pretty extreme example. I think that's probably what's required, but let's just give them the benefit of the doubt and say they make some sort of good faith effort at something that is actual austerity and actual taking of pain amongst politically connected. And by that, I mean Wall Street, the defense, or the boomers. If I see those types of austerity being imposed on Wall Street, defense, or the boomers, maybe. I have seen nothing in my career that has done that. So those are the types of things I'm looking for.
Luke, with that, the idea though of the faith in the Federal Reserve, the faith that they understand what's going on, the faith that Yellen or whoever's Treasury Secretary knows what's going on. To me, you don't need the other things to happen. Then no one's going to wait around for the things you just mentioned, whether they wherever happen or not. The discussion of those things happening will send the markets down. So I guess what I'm really trying to get at here is your idea is don't judge the S&P at 21 times earnings and call it expensive, because there's a built-in cushion here that's going on. There's a reason that it's being elevated and it's trading at a premium. What I'm trying to figure out is not that you're going to be wrong because you've been dead right, but the market won't wait for any of those things to happen. So I just want to clarify that to me, I think you're saying it's the confidence in the system that they understand what's going on.
I think it's a confidence in the system. The other thing that, I guess that you'd have to watch for to be bearish would be the capital flow side, which we never had to think about, but now we kind of do a little bit. And this is something I haven't spent a lot of time thinking or writing about. But when I see one of the presidential candidates talking about taxing wealth, talking about taxing unrealized gains, there is suddenly a capital flow implication there that is potential that would force me to reconsider a bullish view, especially when I marry it with the note I got from my accountant about 3-4 months ago, which is the government wants to know everything you have a beneficial ownership interest in, all private businesses. And if you don't file on time by the beginning of next year, it's a $560 per day fine. As I said to one of my best relationships on the street when I got that, I said, they're getting ready for capital controls. That's what that is. And this other friend of mine who's been doing this at least as long as I have is like, yep. And so when I marry those types of solicitations from the government wanting to know what I own beneficially, it's not like we don't have pretty robust anti-money laundering and know your customer infrastructure built up since 9/11, right? So this is incremental. And then I marry that with what one party is saying about possibly taxing unrealized gains. That's something else you need to watch for, I think, in terms of what could be a negative catalyst for stocks, which is capital flows. Because that's what, I'm not convinced these politicians know what they're doing. Some of them I know they don't know what they're doing. And you saw it today with John Paulson saying, look, if one side gets elected, I'm taking my ball and I'm going somewhere else. And if enough billionaires take their ball and go somewhere else, it's not going to take too many of those guys, those men and women taking their ball to some other locale, be that Switzerland, Cayman, Dubai, who knows, Hong Kong. You can get a capital flow side that is really the Fed's worst nightmare, right? Because that's dollar down, stocks down, bonds down. That's capital out. And now what do you do? So I think that's a tail risk. I think it's now a fat tail risk. But as far as sort of the base case of what could drive stocks down in this system, in the environment we're in, I think it has to be that severe austerity to politically connected entities.
People are going to go back to July 11th and say that was a fascinating day. And this speaks to, I believe, that was a CPI day here in the United States where it came in cooler. Dollar yen was trading approximately 161.5 prior to the release. CPI is released, and I believe the dollar then went in a straight line down to 157. And quite frankly, the yen has been strengthening ever since. And I think what we saw on August 5th was part and parcel due to this, and people have talked about it at length, the yen unwind, the carry unwind trade. Now, dollar yen got down to about 139 and 3/4. As we're sitting here today, it's 142. I also think, as many problems as we have here, we have a bit of a yen problem as well. So maybe I'm a bit too hyperbolic here, but I don't think enough people are focused on what's going on in the, I believe, fifth largest economy in the world. Speak to that.
Yeah, so around July 6th, maybe, we wrote a piece that said 4 highly destabilizing things, part 2. Just happened. Four highly destabilizing things just happened, part 2. And it was in reference to a piece we wrote last year on August 1st of 2023, when we said 4 highly destabilizing things just happened. And those things were oil went above 80. The yen had just fallen to a level. The U.S. had just been downgraded, and JGB, the Bank of Japan, had just widened out the yield curve control range, I think, to, 50 basis points or 100 basis points. I don't remember. But at any rate, we said, look, this is really destabilizing. It's going to put upward pressure on yields, put upward pressure on the dollar, and it was a good tactical call. And so what we noted on July, I think it was July 6th, maybe it was July 9th of this year, but at any rate, it was sort of a similar version of the same 4 highly destabilizing things had just happened, which is to say, the yen had JGB 10 years had just broken out over 1% for the first time in forever. Oil had gone back over 80. We had some politically destabilizing things here in the U.S. with Biden dropping out, and the one thing that was different now this year versus last year in the third quarter was we hadn't had the quarterly refunding announcement yet. We had just gotten the announcement from CBO that they had raised the deficit estimate by 27% June versus February. That was the fourth thing here. So presumably we have this big increase in borrowing needs coming, which all else equal is going to force yields up, destabilize. And so we flagged that again, and we were right for the wrong reason, if that makes sense. We obviously saw a big spike in volatility across asset classes. That didn't surprise me. What did surprise me was that it was the strengthening yen that sort of triggered it. I have been harping on forever. You can go on my X feed and read our reports, harping on forever over the last 2 years that you got to get the dollar down anytime there's a spate of treasury market dysfunction, basically getting the dollar down is keeping dollar liquidity ample is the way you sort of keep the wheels on the cart. And this sort of supports or underpins a lot of what we've talked about up to this point. And in August of 23 said, listen, if they don't get the dollar down soon, things are going to, volatility is going to pick up across asset classes. Of course, they didn't. Volatility picked up. Then came the dollar liquidity in October of last year. Similarly, said, look, if you don't get the dollar down, volatility is going to pick up. They did the QRA. They didn't get enough dollar liquidity. The Fed had their meeting that same week. They didn't do more. They didn't cut. And voila. What surprised me was that the yen strengthening, the dollar actually did get weaker, and now that caused a problem. And that to me was like really mind-blowing, because it set up this problem where if the dollar got too strong, things going to blow up. You're going to have this levered unwind, the 4 highly destabilizing things that we saw in 3Q23 and we saw in 3Q24. But now we had this side I hadn't considered. I didn't realize the carry trade had gotten that big. I mean, it's always known, existed to some degree my entire career, basically. But I hadn't realized that it was so acute at those levels, such that the yen doing what it did triggered the same unwind on the downside. So now you're in this box. And at the time, we wrote another report in August, early August, where we said tactically, the US and the Bank of Japan are going to have to kind of like keep the dollar yen in a range while they let this trade unwind. And if you look at the chart, we wrote that report, I think, on August 6th. And if you look at the chart of dollar yen from, call it August 6th to like a week and a half ago, to me, it looks like, if I'm going off memory here, but the dollar yen sort of chopped in like the I want to say like 144 to 148 kind of level, basically kind of in a level. And my level could be wrong, but it was like a 4 to 5 point range, which brings me to my answer. I think all that's important is background, which is the $64,000 question, I think, Guy, is how much of the leverage were they able to take off while what I think happened, which is they were basically managing yen dollar to a level while people got on sides and degrossed and got lower over their skis. We're going to find out, I think, because I think the yen's going to continue to strengthen, particularly against the dollar after today. And if markets sell back off, then the answer is nope, they didn't degross enough. And if markets react the way I think they should, all else equal, which is bond yields in the US should be relatively stable and the stock market should rip higher, gold should rip higher, then I think we'll know, okay, a bolus of the yen carry trade was degrossed over that 5 to 6 week period of time when when it appears to me that yen dollar was kept in a range. So I agree it could be very important. I think with today's Fed announcement, we're going to find out pretty quickly, but I don't know. I think it's too early to tell.
Well, let's be clear that as people listen to this on Friday morning, we'll have heard from the Bank of Japan. And it's hard to imagine that the Federal Reserve didn't coordinate with the Bank of Japan when they decided to go 50, that they're going to do this. So I would expect actually a little on the margin dovishness out of the Bank of Japan, more than what people are expecting. That's just my take. All right, let's move to gold because all roads lead to gold. I think we said that exact same thing the last time you were on and the time before that you were on. Gold seems like a play that can work in any of the scenarios that we've discussed. It's hard to see it not work. And so give us your current thoughts there. And you certainly can throw in Bitcoin since the crypto people love and adore you, obviously. Guy and I are an anti-crypto people. We just prefer the hard assets with the gold. So give us your thoughts on both of those. But start with gold if you don't mind.
Absolutely. No, and to be clear, I'm a Bitcoin guy. I'm not a crypto guy. I like Bitcoin. Crypto, you can take the rest of it and I don't worry about it. So gold, I still think all roads lead to gold. I still think gold's going higher from here. I think there are numerous catalysts to gold. I think the overlay is that the US fiscal situation cannot be sustained without significantly negative real interest rates for a sustained period of time. That's good for gold. I think we are seeing an ongoing and accelerating shift to gold as a neutral reserve asset, both out of necessity in the aftermath of the Russian sanctions, U.S. sanctions on Russian FX reserves. You've seen central banks buying gold, I think, at an over 1,000 ton per year rate in each of the last 2+ years since we sanctioned Russian FX reserves. And I think it is ultimately an energy play. Ultimately, when we look at this situation, this is the angle that I think is still almost very, very poorly understood. Historically, dating back to the early 70s, with the petrodollar system, once the U.S. went off the gold standard in 71, oil was made big enough basically to recycle U.S. deficits to basically back the dollar. And so over our entire careers, even before we started in our entire careers, when the U.S. needed to reflate, when U.S. deficits rose, the recycling mechanism was oil. Oil prices would go up, right? We saw it in the 70s. We saw it in the late 80s for a cup of coffee. We saw in the 2000s, right? 2003 in our business. Well, it's reflation. And oil was the reflationary asset, more so than gold. I mean, gold went up too, but it was really the gold to oil ratio stayed pretty constant. Oil went up, gold went up through the 2000s. The problem now is that U.S. debt to GDP, specifically Western sovereign debt to GDP, global sovereign debt to GDP is so high that you can't use oil as the reflationary metric anymore, because all you end up doing is creating stagflation. You're going to create higher inflation, lower growth, and those are toxic to high sovereign debt to GDP situations. So you need to be the reflation release valve of higher deficits and higher stimulus and lower rates, negative real rates. Paradoxically, you need an asset that isn't used for anything.
Right.
That's completely useless.
So stop right there. And I want you to continue, but I say this all the time, and I don't know if people fully comprehend, what I'm talking about, but you just said it. Gold is a commodity in name only. It has no end use. So when you talk about how oil can't be that thing, that's because if the price were to go up, you just said it, that obviously hurts growth and creates this sort of spiral. So 100% spot on. I just wanted to sort of, for people that when I say that don't understand, Luke just said it a lot better than I did. Please continue.
Yeah, I mean, you can see going back over 50 years, anytime U.S. oil consumption as a percent of GDP hits 3%, U.S. goes into stagflation and or a recession. And we got pretty close to that 3% number in 2022, and oil was barely over 100. So you can't inflate oil enough to get us out of this problem. You have to inflate something that isn't used for anything, and that's gold. And so interestingly, as gold is getting pulled back into the system as a neutral settlement asset, all of these reasons, the gold to oil ratio has gone from 8 barrels an ounce in 2008 to 38 barrels an ounce. And maybe more importantly, more recently, since the U.S. seized Russian FX reserves, froze them, the gold to oil ratio has risen 110%. It's gone from, call it 16 barrels per ounce to 36, 38 barrels an ounce. I think the gold to oil ratio is going to 50 barrels an ounce. And then I think it's going to 100 barrels an ounce. And I don't think oil's going down a lot to make that ratio go up. I think oil's going to trade in a range of, call it 70 to 90, because above 90, oil blows up the U.S. Treasury market, creates Treasury dysfunction. We've seen that 3 or 4 or 5 times in the last 5 years. Below 70, U.S. shale starts to shut down, and there's a huge decline rate, and that's not good for anybody. So I think you can call up a chart of West Texas at WTI. It's been 70 to 90 for 2+ years, and I think it's going to continue to stay 70 to 90 for political reasons. And I think the release valve is going to be gold and that gold to oil ratio, and that the gold to oil ratio is a pretty good proxy. If you just want to use one thing as a proxy for gold miner profitability, you'd use the gold to oil ratio, and it's blowing out. And gold miners are still well below all-time highs. So I think it's good for gold. I think it's good for gold miners.
I appreciate you. You just basically teed me right up for my final question. Newmont Mining, for example, and I'm not looking to play stock market with you at all, but Newmont Mining, as we're sitting here, is trading $53 or so a share. The all-time high in Newmont Mining, I believe, was made in 2022-ish, and that was north of $80 a share. My point in bringing that up is we've established that gold's at an all-time high. I think we all collectively agree it's going higher. You've just stated that you thought the equity market, for reasons that have made sense and you've been right on, will continue to go higher. My question to you is, if both of those are true, and given the fact that most of these gold miners are now more efficient, running better businesses, better balance sheet, you talk about stocks that are cheap. Well, it comes in the form of gold mining stocks. Just quick thoughts on that.
No, I agree. I mean, I think that gold mining stocks have been suffering from, number one, disbelief that gold would actually do what it's done and continue to do what it's done. And at some point, that disbelief will end, if for no other reason other than price breeds conviction. And I think, too, that historically, gold miners have been a purview of a class of investor that says, okay, well, I think gold's going up, but I don't want to buy gold. I want to buy levered gold, so I'm going to buy miners. And I think in some way, shape, or form, rightly or wrongly, some of that demand for, call it levered gold, has been satiated by Bitcoin and other crypto over the last 3 to 5 years. And so but when you look at, okay, gold, let's say gold stays here and continues to go higher on relatively low vol, that's what's going to take away the doubting about, okay, well, these are normalized earnings for these gold mining companies. Then I think you're going to start bringing generalists into the space for the first time in, I don't even know, a decade, 15 years, 20 years, where they say, look, this is a normalized price of gold. I feel good about that. I feel low vol. And as long as you can feel comfortable with the managements and with the jurisdictions in which they are pulling gold out of the ground, which I think will potentially at some point be an issue if gold continues to go higher. I don't think that's a problem anytime soon. Then yeah, I think these miners probably as a group, the high quality miners in good jurisdictions are probably still pretty undervalued.
So a lot of things you just mentioned on gold do not apply to Bitcoin, meaning the history of it hasn't been a proven, quote, it's not a hard asset, but a proven digital currency or something else other than the dollar yet. So Give us a 1 minute on your current thesis on Bitcoin and why you believe, I can pretty much figure out the answer, that it will perform or outperform from here.
For me, Bitcoin is just an energy linked neutral reserve asset for the people. The energy link is that proof of work algorithm that is usually spun as wasting energy, wasting electricity, bad for the environment. Tomato, tomato. The end of the day, you can't have Bitcoin without a significant expenditure of energy. And so what I want to own are assets that will go up as it gets easier to produce currency, which it's going to have to in order to sustain that government debt level, negative real rates. I want to own assets that are basically energy linked, that will preserve my purchasing power and energy. And that's what Bitcoin does. I look at it as just a neutral reserve asset for the people, energy linked.
You make the arcane accessible, your brilliance. Only extraordinarily brilliant people are able to make what is typically makes the eyes glaze over, make it accessible for people. And we're fortunate to have you. If you don't follow Luke on Twitter, it's at Luke Gromen. He's one of those must follows for sure. Again, we had you on in February, have you on again today. Love to have you on by the end of the year, but know full well you'll be on early next year. Luke, thanks so much for joining us.
Thank you for those kind words, and thanks for having me on. It's always a real blast talking to you guys.